Welcome to our video lesson on value investment, the art of buying stocks that are undervalued by the market. In this video, we will discuss the principles, strategies, and key concepts behind this popular investment approach. Value investing is all about finding stocks that are trading at a lower price than their intrinsic value. This can be due to a variety of reasons, such as a temporary downturn in the industry or a misperception of the company's prospects. The idea is that by buying these undervalued stocks, the market will eventually correct itself, and the stock's price will increase, resulting in a profit for the investor. When it comes to finding value stocks, there are a few key things to look for, such as a low price-to-earnings ratio, or P/E ratio. This compares a stock's price to its earnings per share, and a lower P/E ratio means the stock is cheaper relative to its earnings. Another metric is the price-to-book ratio, which compares the stock's price to its book value. A lower P/B ratio means the stock is cheaper relative to its book value. Let's now see how to find undervalued stocks step by step. Start by researching different industries and companies to identify potential value stocks. Look for companies that have a strong financial position and a history of steady growth. Then analyze the company's financial statements, such as the balance sheet and income statement, to get a better understanding of its financial health. Look for metrics like the price-to-earnings ratio, P/E, and price-to-book ratio, P/B, to determine if the stock is undervalued. Next, look for companies that have a strong management team and a clear strategy for growth. A company with a strong management team is more likely to be able to navigate through difficult times and capitalize on opportunities. Next, analyze the company's competitive position in its industry. A company with a strong competitive position is more likely to be able to generate steady profits and grow its market share. Next, consider the company's valuation in relation to its historical performance and the overall market conditions. If a stock is undervalued compared to its historical performance and the market conditions, it may be a good value investment opportunity. Once you have identified a potential value stock, consider the risks involved and compare it to other opportunities in your portfolio. Diversify your portfolio with a mix of value stocks, to minimize risk and maximize returns. And finally, keep an eye on the stock price over time, and be prepared to hold on to the stock for the long term. Remember that value investing is a long-term strategy, and the key to success is patience and discipline. The optimal numerical values for the price-to-earnings ratio, P/E, and price-to-book ratio, P/B, metrics can vary depending on the industry and market conditions. However, in general, a lower P/E ratio and P/B ratio are considered to be more favorable for value stocks. P/E ratio is a valuation ratio that compares a company's current stock price to its earnings per share. A lower P/E ratio indicates that a stock is undervalued relative to its earnings. P/E ratio of 15 or lower is generally considered to be good for value stocks. P/B ratio is a valuation ratio that compares a company's market capitalization to its book value. A lower P/B ratio indicates that a stock is undervalued relative to its assets. P/B ratio of 1 or lower is generally considered to be good for value stocks. It's important to note that these are general guidelines and not hard rules. It's also important to consider other factors such as financials, management quality, and industry conditions when evaluating a stock as a value investment. Thank you for watching this video about value investing. We hope you found it informative and helpful. Remember that value investing is a long-term strategy and requires patience and discipline. If you want to learn more about value investing, be sure to subscribe to our channel and hit the notification bell to stay updated on our latest videos. Also, don't forget to like this video if you found it useful, and leave us a comment with your thoughts and any questions you may have. We would love to hear from you. Thank you again for watching and we'll see you in the next video.